Good morning, everyone. Today we will start with stockholders equity, and in this particular chapter, we will learn the accounting treatment which we do when we issue equity shares. Right now, as per dual aspect concept, if I talk about equity, means capital. So we know that asset equals to capital plus liability, right? So dual aspect concept says assets equals to capital plus liabilities. Asset means resource, capital and liability means sources of fund. So capital means funds contributed by the owner and liability means fund contributed by the third party, say lender. So from this particular equation we can say that capital is asset minus liability, right? This capital is termed as equity and this belongs to the owner. It means this much fund has been invested by the owner or belong to the owner. Initially when we invest, right, and after some period of time there will be profit, right? So that profit is also given to the shareholder. So this much fund has been invested by the owner or this much fund belongs to the owner, same thing, right? In India we also call it as shareholders fund. This stockholders equity, owners equity, it is also known as shareholders fund. So you have in this capital stock, right? APIC means securities premium. We know that we can issue shares at a premium, right? More than the par value. So that is additional paid in capital. Then we have retained earnings. This is a profit earned by the company. AOCI, accumulated other comprehensive income. Accumulated other comprehensive income. We will talk about each separately. No need to worry about that. Okay. And treasury stock means a company has purchased its own shares from the market, right? Just to decrease the number of shares outstanding, right? Then we have non-controlling interest, right? So each one of this we will explain you one after the another. So what is capital? What is capital? If someone tells me what is capital, capital means the fund contributed by the owner, or after contribution the amount of profit also belongs to the owner. So this funds belongs to the owner or it has been invested by the owner. Any of these you can say. So first we will talk about first component of stockholders equity, that is the capital stock. So these are the components of stockholders equity or the shareholders fund, anything you can say. It's the capital stock plus additional paid in capital plus retained earnings plus accumulated other comprehensive income minus treasury stock plus non-controlling interest, right? So initially we will talk about the first component, that is the capital stock. Now when I talk about capital stock, there are two types of shares you can issue into the market. One is the preferred stock. In India we call it as preference shares. This is preference shares. And common stock means equity shares. Right? Now, what is the difference between these two shares? Basically, the preferred stock, they get preferential rights over the common stockholder. Now, what kind of preference right? Pehle mujhe, right? First me, right? So, what are the preferential rights they will get? One is the rights with respect to dividend, right? First, they will receive, and then after that, the profit will be distributed to the equity shareholder, and then liquidation preference. Now, liquidation preference means, suppose I'm liquidating the company. There is a winding up of a company going on. So after selling off all the assets, we need to first pay all the external liabilities. Balance is available for the stockholders, and among that stockholder, first we will pay preference stockholder, and then we will pay to the common stockholder, right? So he will get preferential right over common stockholder with respect to dividend as well as liquidation. This is very important. Number one is dividend, and number two is liquidation preference. Now, common stockholders are commonly known as equity shareholders. They also get ownership rights in the corporation, and they also get a right to vote. Preference, they don't have the right to vote, but common stockholders, they have the right to vote, right? Now, all the residuary profits belongs to the common stockholders, and in case of winding up, whatever is left after paying all the liabilities and preference stockholders, that belongs to the common stockholders, right? So capital stock comprises of two things. Number one, preferred stock. Number two, common stock, right? So this is one of the component of stockholders equity, right? Next, let us talk about additional paid in capital. Basically, in Indian language, we call it as securities premium. This is nothing but securities premium. Whenever shares are issued above par value, excess is transferred to additional paid in capital. Now, from this additional paid in capital, you need to know one thing, that you cannot give dividend out of it, right? You can only give dividend out of retained earnings. So, we now into the second component of stockholders equity, that is the APIC, additional paid in capital. Now, additional paid in capital can arise when you issue common stock at premium. Additional paid in capital can also arise when you issue preference shares at premium, right? Now, when you do buyback, retired stock means you are just buying your shares and cancelling it off, right? So when you are repurchasing your shares and you are cancelling it at a less than original issue price, then also there will be some kind of profit which will be transferred to additional paid in capital. So additional paid in capital can arise in each of these following situations, which we will cover later on when we do journal entries. So as of now, simply remember, whenever we issue shares at a premium, so there will be excess amount will be transferred to the additional paid in capital, right? So this is additional paid in capital in excess of par. Okay. There are other cases also where which gives arise to additional paid in capital, but we will cover it on bit later when we do the journal entries, right? Okay. Next we have retained earnings. Basically the net profits of the corporation minus dividend paid, right? that is profits retained by the corporation. At the very first year, whatever net profit you have earned, that will be added to the retained earning, and out of that, whatever dividend you have paid, so that will be subtracted. So you have net profit retained by the corporation, right? Basically plowing back of profits, right? We know that in order to have a proper growth of the corporation, we need to plow back profit, then only we can see the effect of growth. Now this retained earning represents accumulated profit which has not yet been distributed to the stockholder as dividend. Not yet been distributed to the stockholders as dividend means these are retained earnings, plowed back profit. Now it increases when we have net profit, and it decreases when we pay dividend. Simple. I told you, net profit earned in each period is added to retained earning, and whatever dividend you paid, that will be subtracted from retained earning. Now at times you do a lot of appropriations, right? We know that in case of any possible obligation which will arise in future and it will lead to loss to the corporation, then you need to account for such possible losses in advance as per prudence principle, right? Account for possible losses in advance today as per prudence principle. So what you do, whatever profit you have earned, that you have already transferred to retained earning. So from that retained earning, you just create a provision for that, right? So what do you do? A portion of retained earning is appropriated to meet certain contingent liabilities, which may require large payments to may be made in future. So as per prudence, this is a few possible loss, and you need to account for today as per prudence principle, right? So whenever you do this type of appropriations, then appropriated reserve is blocked for that particular purpose. You cannot use it for the purpose of dividend. So out here, what they have said, $50,000 is appropriated from retained earning for possible losses for pending lawsuits. There was a case against me, and now the probability of losing, I am on the urge of losing, so I need to create a provision for that. So what will I do? Whatever retained earnings we had, from that we are going to create a provision for a lawsuit, right? So the unappropriated reserve and surplus, it will decrease. So we debit that, and reserve for lawsuit will increase. So we credit that. However, if I see the balance sheet total, there is no difference in balance sheet total, right? There is no difference in balance sheet total. One reserve is getting decreased and the other reserve is increasing. So basically the unappropriated reserve and surplus will fall, and retained earning reserve for lawsuit will increase, right? Now when this liability actually matures, or when this liability do not mature, in case even if cost occurs, right? If cost occurs, then this losses, actual losses, are recorded in the books, and this journal entry is reversed. Anyway, we are accounting for these losses separately, so we will reverse this journal entry, right? And if costs do not occur, so similarly this is no longer retained, so anyway we will reverse the journal entry. Under both the cases we have to reverse. Even if we require or we don't require, under both the cases we are going to reverse this journal entry, because if you don't require, then no problem. We created a provision that is no longer needed, so reverse that, decrease the provision, and again increase the retained earning unappropriated, right? And if the liability actually matures, then in that particular case what will happen? If liability actually matures, then what will happen? I am going to account for that loss separately. right? I'll account for that loss separately, right? So this particular reserve entry needs to be reversed, right? Now disclosure is only required for reasonably possible cost. Now this I told you about possible losses, and this is reasonable, right? And this is probable but not estimable. Now you need to note one thing. Suppose someone has filed a case against me, pending lawsuit. If I talk about pending lawsuit, right? If the chances are very remote, chances are remote means less than 5% that I lose. Right? No, no. Reasonably possible means 5 to less than 50. No, but disclosure is required. Probable but not estimable. This is more than 50%. Since the amount cannot be estimated, you cannot create provision, but disclosure is required. D. Yes, yes. Now this thing you have to remember with respect to pending lawsuit. This is very important. You get a lot of MCQs and SIMs based on this particular chart itself, right? So if the chances are very remote, means less than 5%, no need to disclose, no need to do any kind of accounting treatment. When there's a reasonable possibility that you might lose, then also you don't need to do any kind of accounting treatment, but facts should be disclosed in the stockholders equity section, right? Now whenever you prepare any kind of PL and balance sheet, it is not just a preparation of PL and balance sheet which is relevant, it is also relevant as to what needs to be disclosed to the readers of financial statement and what need not be disclosed to the readers of financial statement. Its presentation, its disclosure, its treatment, everything matters a lot, right? The treatment part, the preparation part, the presentation part, and the disclosure part. So whenever you prepare any company's, any corporation's financial statement, you are not only going to focus on the preparation part, you're also going to focus on the presentation part as well as the disclosure part. This is also very, 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 very important, right? If, sir, I know how from a trial balance, I know how to make a PL and a balance sheet, it won't serve your purpose, because there are a lot of information which needs to be disclosed to the readers of the financial statement, right? If you see mandatory requirements for the US GAAP, you need to prepare statement of comprehensive income, which is the PL. You need to prepare statement of financial position, which is the balance sheet. in some cases you need to prepare statement of cash flows as well, for only to the mandatory for the corporations. We need to prepare statement of changes in equity, and we need to prepare notes to the financial statements. Now these notes to the financial statement contains a lot of disclosure, and there are some specific disclosures with respect to each item of the balance sheet. So this is the disclosure requirement under the stockholders equity section, right? So you need to present things properly. Like if the chances are very less, then accounting treatment is not required. Disclosure is also not required. 5 to 50%, no accounting treatment, but disclosure is mandatory. More probable means more than 50%. The chances of losing is more than 50%. So I need to create a provision for the same. However, is the amount estimable? No. So you cannot do any kind of accounting treatment, but needs to be disclosed. But if you can do accounting treatment, yes, the unappropriated reserve and surplus will decrease, and the pending reserve for pending losses will increase. If losses occur or do not occur in future, it depends, right, on the court's judgment. However, as far as our treatment is concerned, if cost occurs, we create a loss for that and reverse the provision created. If costs do not occur, no accounting treatment needed, reverse the provision created. Under both the cases, this treatment is same. We need to reverse the provision which we created, right? So we covered capital stock, we covered additional paid in capital, we covered retained earning. Now it's term for other comprehensive income. Now when I talk about other comprehensive income, it clearly tells me about unrealized profit, right? Unrealized profit, or we can also call it as okay, fine, unrealized profit. Now other comprehensive income means it is related to your pension adjustment, right? This will be covered to the discipline subject, business analysis and reporting, right? Available for sale debt securities, this we will cover when we do investment in bonds. Currency translation gain loss, again this will be covered in business analysis and reporting. Some advanced topics of PAR has been moved to the curriculum of BAR, right? Effective portion of derivatives held as cash flow hedges, again this is the topic of BAR. Right? So these are generally unrealized profits, right? This is not earned profits. These are not related to your day-to-day activities, right? So these type of profits are not included in retained earning, rather it is shown separately in stockholders equity. You can see this is shown separately as other comprehensive income, right? Now whenever there is any change, right, so that changes is not included in net income, rather it is included in accumulated other comprehensive income, right? So reflects cumulative. Yes,
The pension adjustment, how it is unrealized profit, it is a expense now for the
no. Pension, basically pension which we are basically it's a type of provision we are creating. We will be paying it not now, right? It is not an actual expense, right? So when we are going to pay it off, when the employee retires, right? So these type of adjustments needs to be considered as other comprehensive income. You cannot treat it as the regular your trading activity, right? Is it fine?
Yes, sir.
Okay. Now there are some reclassification. So this also we will learn when we do this. So this topic and this topic will be covered in detail when we do investments in bond. Like one of the other comprehensive income can be revaluation profit. This is also unrealized, but as per US GAAP, this is not covered. In IFRS, if you see, you will get one more, that is R. PACER. R means for revaluation profits of non-current assets. So this is as per international financial reporting standards, not as per US GAAP. So when we revalue any kind of non-current asset or any kind of intangible asset, so again that reserve is also unrealized, right? So this thing will be covered. This is as per IFRS only, right? That revaluation is treated as your unrealized profit. As far as US GAAP is concerned, these four will fall under other comprehensive income. Any changes in asset due to these four items will fall under other comprehensive income. Right, it is not included with the net income of the organization. It is being treated separately. Only profits related to the owner are considered in net income. Okay, chalo. So next we have issue entry, the journal entry for issue of common stock. This is quite easy. We have done in our +2 level. So this is similar entries you have seen in your +2 level. So we will quickly go for it. So when you issue stock, means common stock at par, so you do cash debit and common stock credit. Simple. This is normal issue of shares. So cash debit to in our +2 level we used to do like this, cash debit, then we have to have equity share application credit, and then we used to do equity share application debit and then equity share capital credit, right? So this 2 gets cancelled off. So ultimately we have cash debit, equity share capital credit. So in US we don't call it as equity share, we call it as common stock. Now when we issue shares at premium, 10 par value, issuance is at 12. So the excess is being credited to AICPA. APIC, additional paid in capital. I told the institute name AICPA. So it is additional paid in capital. Just like securities premium, nothing else. So the common stock is being credited with the par value, and excess over par value goes to APIC common stock. Now we might issue stock in installments. We might take some amount at the time of application, and when the stock is allotted we can take the balance amount, right? So this is like the shares are issued for 12 rupees, right? The shares are issued for 12, and I will collect 9 later. 3 I will collect now, right? So you took 3. Subscription receivable is 9. So this is total 12. Common stock subscribe means just like equity share application. This is just like equity share application, and this is additional paid in capital common stock. So 12 is the issue price. Out of that, 3 is collected now. So 9 will be collected later. So that's application receivable. Subscription receivable 9. Just a debtor. Just like debtor. I have sold you shares and this money is receivable from you. So the total is 12. Now, as of now, the shares are not yet issued. So we cannot say the common stock directly. We cannot credit, right? So we say common stock subscribed, and the balance goes to the additional paid in capital. If you receive the balance money and the stock is issued, you are going to do 2 entries. We can split and do 2 entries, no problem. I have combined, but you can do 2 entries. Number 1, cash debit and subscription receivable credit. And then you can issue stock. So this is common stock subscribed debit and credit common stock. So it is this and this. So you can show 2 entries, no problem. No need to show one single journal entry for this. You can show 2 different entries, not a problem. So we need to show the debtor for the balance amount receivable, and later on when we receive, simply issue stock. That's it, nothing else. Now, in case of oversubscription, oversubscription, we won't be able to allot shares to every applicants, right? So to some applicants, we have to refund the money. So in that case, just the reversal of the receipt entry. Reversal of receipt entry. Simply I am cancelling the subscription. I cannot allot. In case of oversubscriptions, I cannot accept all the applications, so I have to reject few applications and refund their money. Now once I have allotted if the shares, you are failing to make the balance money, right? So what will I do? First of all, I have to cancel whatever I credited. And in this case, you are not going to refund the money which the investor already paid, rather than you are going to forfeit it. So this is additional paid in capital forfeited subscriptions. Amount received from investor forfeited. This is oversubscription. You are not allotting them shares, so you need to refund their money. This is shares are allotted. Shares are allotted, but shareholder is breaching by not paying the amount due. Okay, so this is issue of shares in installments. So whatever you receive, you debit cash and balance is debtor. When you receive the amount from debtor and issue them stock. In case of oversubscription, if applicants are not getting any shares, refund their money, and if the shares are allotted but the shareholder is failing to make the payment, forfeit those shares. Do not refund it. So basically it's a type of gain. This is a gain. Now right shares, stock rights, this is just like normal issue. The entry is quite similar to normal issue, but you need to understand what is stock rights. Now suppose the company needs more funds. The company already had company has issued 1 lakh common stock. Company needs funds for expansion. Company needs fund for expansion. Now if company can go for fresh issue, more issue, then what will happen? The control of the existing shareholder will dilute. Suppose company issues another 1 lakh common stock. Then what happens? Suppose out of this 1 lakh, my holding was say 20,000 shares, right? So now I am having a 20% holding in this company. But say company comes up with a public issue, company floats another 1 lakh common stock in the public. Then I may not subscribe, I may not get the opportunity to subscribe in that another additional 1 lakh common stock which the company has issued. Then in that case, what will happen? The total number of common stock will be 2 lakh. And out of that 2 lakh, how much shares I have? Only 20,000. So the my holding will be 10%. So earlier it was 20, now it has become 10. So my control has get diluted. So this may not be fruitful to the existing shareholder. That is why company comes up with stock rights. Okay, you need fund, na? What is your objective? Your objective is to issue shares to outsider, or your objective is to get funds? I need funds, whoever can give me, as simple as that. So you can go for stock right. These are preemptive right. It gives preemptive rights to the existing shareholder and they get the opportunity to buy additional shares. They get an additional share buying option. And generally this stock rights is being issued at a price less than the market price so that everyone grabs it. So if I have subscribed for it, then normal, company is receiving money. Whatever entry we are doing it from the point of view of the company, issuer. So the idea of stock right is different from the normal issue, but the accounting treatment for both the cases is same. Suppose the market price is $15. You have issued, this is market price, issue price is 13. Fine, no problem. Company received 13. par is 10, additional paid in capital is 3. Right? The existing shareholder gets a preempt. Because they are the existing shareholder, they are getting the opportunity first to subscribe for additional shares so that their holding remains intact. The percentage of their whatever was their previous holding in terms of percentage, that will remain the same. What if they don't want to subscribe for it? They can renounce it in favor of another person, right? That is sale of right forms. I don't want to subscribe for it. The company is not performing well, so I can sell those rights to someone, and through that right, the someone can subscribe, right? Anyway, journal entry for preferred stock. This is quite similar to what we have done for common stock. So if 10 par value stock issued at $12, so this is getting credited with par value, and this is excess above par value. Right? So in the very first discussion, I had told you additional paid in capital comprises of, see, excess over par value, excess over par value. There are more things that comes under additional paid in capital, which we will discuss slowly. Okay. Now let us discuss a few things about types of preference shares. Cumulative and non-cumulative. In case of cumulative, suppose I haven't paid dividend in earlier years because the profit was insufficient, so that dividend is in arrear. Whenever profit arises in future, first dividend not paid in earlier years will be paid, right? First preference dividend in arrear, then current year preference dividend, and then equity dividend. If it is cumulative. If it is non-cumulative, it is just like shares. No dividend is in arrear. Fine. If I get profit, first I will pay current year preference dividend and then equity dividend. What is participating? Participating means after paying normal dividend to the preferred stockholder and the common stockholder. Suppose my preferred stockholder, the dividend rate is 8%. So first I will pay them 8%. Similar 8% will be paid to the common stockholder. After paying the normal rate of dividend to preferred stockholder and common stockholder, whatever is left, that will be distributed among these two classes on the basis of paid up capital. We have an example, we will do it. Okay. Now convertible preferred stock means these are potential. Common stock, Means these preferred stock will be converted to common stock at an agreed ratio. The ratio has been already pre-decided at the time of issue, and after some years it will be converted into common stock. So these are convertible. You need to understand different types of preferred stock, preference shares. Preferred with warrants. These warrants are detachable. From preferred stock and convertible into common stock. Preferred with warrant means the shares are not converted into common stock. It is the warrant that is being converted into common stock. In case of convertible preference share, the entire preferred stock is getting converted into common stock. But in case of preferred with warrants, only the warrants are getting converted into the common stock. The preference shares still exist. Callable means redeemable. After some period of time, we will pay you back. The word redemption means repayment. Repayment. Mandatorily redeemable. Preferred stock liability. This is almost debentures, oblique bonds. Redemption is fixed. Occurrence of event beyond the issuer's control holder exercises option. So it needs to be shown between equity and non-current liability. Like in balance sheet, we have equity, stockholders equity, we have non-current liability, and then we have current liability. It is between this. So the cumulative preferred stock means if you haven't paid dividend to these preferred stock in earlier years, you will be paying it now when the profit is available. Participating means after paying the normal rate of dividend to the preferred stockholder and the common stockholder, balance profit will be distributed to both these stockholders. Convertible, the share itself is converted into common stock. Preferred with warrants, only the warrants are converted into common stock. Callable means this is redeemable at agreed price by the issuing corporation. And mandatory redeemable preferred stock, it will be shown as a liability because the repayment date is fixed, redemption date is fixed, or occurrence of an event which is beyond the issuer's control. There might be some covenants which was attached to this preferred stock issued. Might be the company has breached those covenants, so now we have to redeem it mandatorily. Okay. So there is one example based on this cumulative and participating, how to distribute profits. Let us do that. Okay. Dividend distribution among preferred stock and common stock. On 1st January 2020, 50,000 shares of 10. So common stock is 50,000 into $10, that comes to $5 lakh. And this is 50,000 preferred stock. Again, this is 5 lakh. This is 10% cumulative. This is cumulative as well as participating. No dividend is paid in 2020. So this is dividend in arrear. In 2021, we have paid dividend of 190. First of all, less. First of all, since it is cumulative, so we have to pay preferred dividend in arrear for 2020. For 1 year. After paying this, now we will pay less. Preferred dividend for 2021. Now since this is participating, so we will pay equity common stockholders. dividend for common stockholder for 2021 at normal rate. So the rate will be 10% and the common stockholder amount is 5 lakh. Balance is distributed among preferred and common. $5 lakh. It is same. So now we can see preference shareholders, preferred stockholders, they are getting last year dividend, current year normal dividend, plus they were participating, so they also participate in the surplus. So total preferred stock 50,000 they won't get arrear one, normal plus participating. Okay, so since it was cumulative, so first we paid the arrear one, then we will pay current, and since it is participating, so we first pay normal rate and then the balance is okay. Now suppose if I say, suppose in the above case preference shares are non-cumulative. So what is total dividend paid? Non-cumulative, but participating. Total dividend is 190 less preferred dividend of 2020 is not to be paid because this is non-cumulative. Preferred dividend for 2021 common stock dividend for 2021 at normal rate. Balance among preferred and common. Right? Suppose non-cumulative and non-participating preferred stock. For 2020 we won't pay. For 2021 we pay 50, 5 lakh at 10%. Now in this case, since it is non-participating, whatever is left, it will go to common stockholder. Whatever is left, it will go to common stockholder. Okay. So that's it from today. There is one more class for this stockholders equity. We will do it. We'll finish the other stuffs in the next session. Okay. Bye bye.